I do believe that we're going to start to see more broadening out into other sectors beyond technology. And a lot of it, I think, is going to be driven by companies that can successfully adopt AI and integrate AI into their business to make them more productive. And I have a few examples that I wanted to share. After many, many years of US outperforming international stocks, 2025 was a change in that narrative, with international stocks not outperforming by a little, but actually by a lot. If you were to measure the returns in US dollars and look at the total return, including dividends, European markets and Canada outperformed the US by about 2 times. And then in Japan, the markets there outperformed by nearly 1.5 times that in the US. So some meaningful outperformance by markets outside of the US. And then on the second point, quality, which over the long term is a factor that's done very well, has outperformed the benchmarks over a long period of time, but not in 2025. The year started off okay for quality, but what happened once the markets recovered from the Liberation Day tariff announcements from what was announced by Donald Trump, the market leadership was basically in high beta, high volatile stocks, heavily shorted stocks. And in that type of an environment, it was full risk on, and quality stocks lagged. And so given these two developments, I just wanted to talk about how Core Global did in that environment. And Core Global underperformed its benchmark, and 2 main reasons for that. The fund wasn't significantly overweight the international areas, which outperformed, but it is very much a quality focused fund. And so with quality underperforming, there were a lot of stocks in the portfolio that just didn't keep up with the benchmark. So that's why the Core Global Fund lagged its benchmark in 2025. I am going into this year with a cautiously optimistic outlook. There is a lot of monetary stimulus that's happened. The central banks around the world had a lot of interest rate cuts last year, and monetary policy works with a lag. So a lot of the cuts that happened last year are going to be felt, as we get going into 2026. In addition to monetary policy, there's a lot of fiscal policy happening. In the US, we have the One Big Beautiful Bill. In Europe, there was a big announcement by Germany's government to increase their spending on infrastructure and defense spending. And that part of the world hasn't seen this type of stimulus going all the way back to World War II. So it is a big deal. And then in Japan, there's also been some fiscal stimulus announcements very recently that are as big as anything that we've seen since COVID. So we have monetary stimulus, we have fiscal stimulus. Corporate earnings have been resilient, energy prices are low, and we're in the middle of a CapEx supercycle led by investments in artificial intelligence. So for all of those reasons, I have this cautiously optimistic view as the year gets underway. One of the opportunities that I see is in international stocks. Even though they outperformed by a wide margin in 2025, this has to be taken in the context of US equities outperforming for the better part of the last 15 years. So international stocks still have some catching up to do. And if you look at the relative valuations, they still trade at a discount to where they've been historically. So seeing some opportunity in the international stocks. The other opportunities are in certain sectors or subsectors that have been left behind in the market that we've been in for the last few years. Healthcare would be one of the sectors that has lagged meaningfully, and it has started to rebound, and we do believe there's more to go. So we've been looking at opportunities in healthcare, and then in some subsectors. I'll use U.S. housing as an example of an area that we've been putting money to work. This is a sector that has been out of favor, until recently. Rates were pretty high in the U.S. They're starting to come down now, and we believe there's going to be some tailwinds for the U.S. housing sector. In terms of the risks, I would put inflation, the potential for a renewed bout of inflation in 2026. And the reason I say that is the fact that we've got a lot of monetary stimulus that was put into place last year. We have a lot of fiscal stimulus that's going to be going into place this year in 2026. Governments around the world and the banks are running it kind of hot. And so there is potential for inflation to heat up again. So that's something that we'll be watching. The fund's very well diversified by geography and by sector. We're not making any supersized bets on any one sector. And when I say it's diversified geographically, I'm talking about, the businesses and where the operations come from, not where the companies are domiciled. This is a very global focused portfolio. And the other thing about the positioning of this fund is that it is very well positioned to take advantage of some of the mega trends that are going on around the world. There are a lot of mega trends, just to name a few of them: artificial intelligence, decarbonization, innovative healthcare. Those are, some of the thematics that this fund is involved with and will benefit from. In terms of, what might be done differently and what's not going to be done differently, at this stage, as I've highlighted earlier, I do think there's some real interesting opportunities internationally, just because international stocks up until 2025 had lagged the US for a very long time. So I've been spending more time looking at companies in Europe and Japan, and potentially looking to increase that weight in the global fund. In terms of what's not going to change is the emphasis on quality. Quality is a style that has been used throughout my entire career, and for the time that I've managed this fund, I believe in owning quality companies. I want to own the best businesses in the world, and the highest quality businesses, and we'll continue to do that. So there's not going to be any change in that regard. I really see a broadening out beyond the technology sector. As everyone knows, tech has been one of the best performing sectors for a very long time. In recent years, it's been driven by artificial intelligence. And I do believe that we're going to start to see more broadening out in 2026 into other sectors beyond technology. And a lot of it, I think, is going to be driven by companies that can successfully adopt AI and integrate AI into their business to make them more productive and more efficient. And I have a few examples that I wanted to share. JP Morgan within the bank sector is being widely recognized as one of the banks that has invested the most in AI. And one example that they gave is that they're using AI within their fraud prevention businesses, and that they have been able to realize about $1.5 billion in savings from reducing fraud. Another example would be Walmart. Walmart has been using AI across the business and extensively in what they call the cost to serve the customer, and they've actually seen a 20% decline in what they call the cost to serve the customer, and there might even be upside to that number as time marches on. And then finally, Eli Lilly, the pharmaceutical company, in conjunction with NVIDIA, they have built an AI factory, they call it, inside their company. They're basically using AI across the entire company, and they've noticed a significant uplift in their gross margin in the last couple of quarters, which they attribute to AI. So this is, a broadening out theme. JP Morgan's a financial, Walmart is a consumer staple, Lilly is a healthcare company. These three companies are companies that we own in Core Global, and there's a lot more companies out there like that are using AI to transform their business, and that's the kind of broadening out theme that I see happening. I'd start off by saying that I'm cautiously optimistic on the outlook for global equities for 2026, and factors, for that would include the monetary stimulus that we saw last year, the fiscal stimulus that is just beginning now, the resiliency that we're seeing in global corporate earnings. The Core Global Fund is a high quality fund. We're trying to own the best businesses in the world, and also take advantage of the mega trends that we see in the market today. And most importantly, I think this is a really good time for investors to own quality, given that we had one of the largest periods of underperformance going back 20 years for quality in 2025.